Hi, I'm Reneé Friedman, Editor-in-Chief here at EXANTE. Welcome to the first in our new series, Horizon Bites, where we'll be meeting with global experts to discuss global equity markets, bond markets, emerging markets, commodity markets, and much, much more. In today's conversation with Arnab, Global Macro Strategist at Invesco, we'll be discussing what's going on with the Fed and the ECB, as well as the Bank of England. We'll also be discussing what's happening in global commodity markets, emerging markets such as India and China, what's happening in equity markets, and of course, what may happen in the US election. Let's start off our discussion today about what's happening with the US economy and the US Fed. Where do you see the Fed moving? How quickly will it move? Why will it move? Why may it not move if we potentially see a soft landing, a no landing, or a bumpy landing scenario?
Well, so we're in the bumpy landing camp, right? I think expectations around what kind of landing, or like you say, no landing, if the U.S. is going to have a landing at all, moved around quite a lot over this period since the pandemic and the war, the high inflation, and the very aggressive Fed tightening. So look, I think we have had a lot of structural change and big structural shocks, mainly the pandemic in the case of the U.S., right? Shutting down essentially the services sector, flipping the switch, turning it back on. In the interim, people saved a lot. They got a lot of money from the government, from the federal government, right? For the first time ever in a downturn, right? Disposable income went up, household wealth went up, and because the Fed and the Treasury were doing so much to keep everyone going, right? Maybe too much. And I think that's a big part of the inflation shock as well as the supply side shock. Now, a lot of that stuff, both the supply shock and the demand shock, they're coming out of the data, coming out of the economy. So we're sort of normalizing. And so I'm in this bumpy landing camp. And I think, Invesco as a firm, we don't generally have a very strong, single house view, but I think most people in Invesco are in that camp too. Not a soft landing because we've had a lot of aggressive tightening and the economy is starting to finally slow down once again, right? You see some signs of weakness in the labor market, although there's been quite a lot of growth.
The growth number we saw on Friday, the non-farm payrolls number was 275,000.
Was very strong, yes.
Very, very strong.
Although January and December was revised down. So it's not as strong as it looked right at the beginning of the year, at the end of last year. Although, yes, the economy has been much stronger than most people expected. And I think that's because of the structural change that has taken place, right? The federal government has thrown a lot of money, not just at COVID, but at through the so-called Inflation Reduction Act, at the supply side of the economy. Construction is really strong. There's an investment boom and maybe a bit of a manufacturing renaissance underway in the U.S. And all of that has changed the dynamics in the labor market at a time when labor supply has become more constricted, right? More restricted because society's aging, immigration has come back, but a lot of people have exited the labor force, early retirements, although some of those
that labor force participation rate really hasn't moved.
Right. It's starting to creep back a little bit, but it's well below,
it's below
where
the average.
It was, and which is a contrast to Europe. We can come back to that later, but the labor force participation rate has been hit. It's starting to make to come back. But I'm just saying, from the point of view of the economy, labor supply has been more constricted at a time when demand for workers in services and construction, to some extent manufacturing, has come back quite strongly.
So with that wage increasing, but that it leads to increasing wage pressure, obviously.
Absolutely.
And given that we're looking at that increasing wage pressure, even though that pace is starting to decline, as we saw in last Friday's numbers, it's still quite high. And it still means that it's going to be above Fed target in terms of being able to reach that 2% inflation level target. So where does that lead us in terms of that potential time frame for Fed cuts, if any, this year?
Oh, absolutely. Look, I think this is why we're sort of in the bumpy landing camp, right? Because there are a lot of forces holding the economy up and keeping wages, as you say, up, keeping some upward pressure on the inflation rate. And that's why the Fed has been so aggressive, part of the reason why the Fed's been so aggressive until recently. And probably part of the reason why the Fed itself is a bit conflicted about when and how much it should start to cut rates, right? And that's why we keep having these conflicting signals, hence the kind of bumpy landing, catchphrase that we like. So look, I think, for choice, the rate cuts are going to start somewhat later than the market had been pricing in. It looks like we're now talking about June, maybe sometime in June, July, something like that, and maybe fewer cuts than people had been hoping for and the market had been pricing. Right? I think most people thought, when the Fed tightens, particularly this aggressively, something breaks. And the financial system started to break a year ago. And we've had, New York Community Bank come under pressure recently. But I would say, I think, to me, these look like idiosyncratic, sort of bank-specific issues. And what's most important is that the problems that they've had in the banks have been mainly interest rate losses on treasuries that were not marked to market, not credit losses. Right? Normally when something breaks, it's because there's been a big leveraging up of the private sector that comes under pressure. We don't really see that happening this time. It's more likely that the longer that rates stay higher, that some debt has to be rolled over at higher and higher rates, and that becomes more and more difficult, and that more gradually slows down the economy rather than causing it to come under a big collapse as highly leveraged entities start to fail. The big picture here is that in the period of very easy money, we didn't have a big leveraging up of the private sector in order to invest in housing or in manufacturing or really in anything except financial engineering of various kinds. Right? It was some debt issued by corporations to buy back stock. And then in the late part of the easy money period, we had a lot of treasury issuance. The real build-up's been in the public sector, not in the private sector.
Going back to the Fed action itself in terms of the rate on this, of not just how frequently they're going to cut rates this year or to the level that they'll cut rates, but it's also this point of, does the Fed have, or does there exist, a new neutral rate in the U.S.? Given these particular demographic changes that you mentioned, the fact that we are looking at a structurally different U.S. in many ways.
Right. Look, I think, we have different forces pulling the neutral rate, the rate at which the Fed is neither stimulative nor restrictive in different directions, right? So the demographics, as you say, that's a factor that probably pulls the neutral rate lower because the society is aging and maybe eventually be a smaller population, and that's certainly what happened in Japan. And the New York Fed, which seems to be the keeper of the neutral rate view for the Federal Reserve System, they clearly think the neutral rate hasn't really changed much and may have some downward pressure. On the other hand, we have fiscal activism, maybe we have regulatory activism, we have trade barriers, we have investment barriers, we have the green transition. In some probability, right, we have some investment to do for all these things. And we have a kind of a residual that productivity in the US is rising, right? Because inflation has been falling, growth has been holding up, and the labor market's been strong, as we were just discussing, right? So, GDP's been growing at what most people, including ourselves, think is well above potential, 2.5 to 3.5, something like that over the last couple of years. And yet inflation has been coming down. So productivity famously is a bit of a residual, and it seems like there's a productivity boom going on. Maybe part of that is structural. Maybe part of it is kind of, it's just a kind of coincidence of all these things happening, all these shocks after COVID. Maybe part of it is structural because the trade barriers, the investment barriers are likely to remain. Maybe they'll go up to some degree, maybe not, but they're likely to remain. They seem pretty unlikely to be reduced. The pressure for national security reasons and also domestic political reasons to reshore, nearshore, friendshore, all of that is likely to continue. So
and
for
perhaps
the world,
actually strengthen depending upon the results of the upcoming U.S. election, which as we know is the biggest risk event this year and for many years potentially.
Absolutely. There's a lot of stuff up for grabs in this election, right? But yeah, so all of those things probably imply that tangible investment, physical capex in the US, in the West, in many parts of the world, rather than just Asia Pacific and rather than mainly China, are likely to be higher than they were, than it was, right, in the past. So that suggests that the demand for real resources will be increasing and maybe redistributed around the world to some degree, which probably implies a somewhat higher neutral rate, or at least upward pressure on the neutral rate in parts of the world, right?
Well, not just in the Fed, but let's move quickly to the ECB then, because then that has implications for ECB actions. And the ECB has been dithering, shall we use that term a little bit, over the past couple of months, demanding to see what the data is showing. There are concerns around wage pressures, because again, it's a structural issue within Europe, but it's a different type of structural issue than what you have in the US. We still have very high, relatively speaking, youth unemployment. Even though unemployment overall is at a historical low in Europe, it is still quite high amongst for 16 to 24-year-olds. What are the implications then if the Fed says, right, we're having a higher neutral rate for the ECB, given what we're also seeing in terms of stagnation, particularly manufacturing coming out of its largest economy, Germany?
Absolutely. Look, I think the neutral rate changes in the neutral rate may be different from one part of the world to another, right? And I think there's a strong argument to say that the U.S. seems to be pulling away from the rest of the G7, right, or the rest of the developed world, right? You look at per capita GDP, if you look at just the level of GDP, real GDP, all the indicators suggest that the U.S. is, doing much better than many parts of the world. Of course, it has an inequality problem. There's a distributional problem, as there is in many parts of the West, but there isn't a growth problem, right? Maybe some of this is down to fiscal, and maybe not all of it is private sector animal spirits, although there seems to be a lot of that too, much more than here in Europe, continental Europe, or indeed the UK, right? So part of that, as you say, I think, is the labor market. The Eurozone is very interesting that although youth unemployment is high, the labor force participation rate in the Eurozone is also
higher than
the US. Yeah. And it's gone right back quite quickly to the pre-pandemic trend in the Eurozone, which has not been the case in the US and the UK.
It's particularly happened in those periphery countries, and we've seen that reflected in the growth in those periphery countries, Spain, Italy, etc.
Even Greece. Yeah.
Even Greece, of course, as well as the yields on the bonds.
Yes.
Their sovereign bonds coming down quite significantly, and we look at that spread between Germany and between France as well. We compare them to them. Where does that leave the ECB and particularly the euro as a currency vis-a-vis the dollar? Because you're calling potentially for dollar weakening, but yet if you're looking at potentially a higher neutral rate, what are the implications then for the euro in terms of its value both against the dollar, against the pound, against the Swiss franc, against the yen?
Well, so I think, we have a view, and I personally at least have a view of a softer dollar in the near term because I think, essentially what we're talking about is the Fed being done, and the question is when does it cut and how much does it cut? ECB is also very clearly done, and the argument is stronger, if anything. The Eurozone, as you say, is in closer to recession than significantly maybe than the U.S. I think there's still a case for dollar softening in the near term because I think the market, expect the entire Western world to ease more slowly, perhaps than it did, but more or less to the same degree. And if anything, maybe it's expecting the ECB to have to ease even less, or to be able to ease even less than the Fed in a way, right? Although the ECB has arguably been a little bit more dovish than the Fed on the margin, the market pricing is not really suggesting the ECB is going to cut very aggressively because although there are recession concerns, there are, Germany may be stagnating, the periphery, as you say, the services economy in Europe is doing quite well. The labor market is very tight, even though labor force participation has risen. Unemployment for the Eurozone as a whole is at a record low, notwithstanding the problem with youth unemployment. So you have this quite rigid labor market in the Eurozone, unlike in the US. And so, if anything, for any given change in supply-demand dynamics, there's more wage pressure in the labor market in Europe than there is in the US, right? Neither really has a wage price spiral going on. But if anything, Europe has more of that problem because it's just a less flexible, adaptable economy, which is again why the neutral rate in the Eurozone probably hasn't risen much at all, and probably not as much as in the US. If you believe my story that in the US things are really on the move, whereas maybe less so in Europe. And I think sadly, Europe is wonderful to live in, great to visit, but it's not necessarily the best place in the world to move the technological frontier, right? The fourth industrial revolution, all this AI, most of that is coming out of the US, and to some extent maybe China, but manifestly not coming out of Europe. And to the extent that stuff happens in Europe, it goes to the US to be commercialized, right? So I think, that technological frontier, the kind of productivity boom that is taking place in the US, there's some of that maybe in Europe, but not nearly as much.
So, in terms of, we've spoken about Europe, we've spoken about the US, and the technological revolution, where does that actually leave some place like the UK, which is between the two in terms of both in policy, in many ways?
Yeah, I think it's a very good way of putting it, right? It's transatlantic, it's sort of, famously likes to have European social services and US taxes and has a somewhat more flexible labor market than continental Europe. Look, I think the UK has done itself no favors in recent years, even a decade and a half, really, since the GFC. Productivity growth has been very weak here. Brexit has been a big own goal, I would suggest. The public seems to have turned against it. Maybe not enough to relitigate it and try to rejoin the EU. But, I think there's a real kind of sense that some big mistakes have been made, and maybe there's been a bit of a walk on the wild side with the Truss government that came and went, and all this round robin of prime ministers, a lot of policy uncertainty.
There's very little reaction, actually, to last week's budget in terms of currency reaction. I mean, the sterling has been one of the best performers this year.
That's absolutely, and I think that's, again, sort of the here and now is that the UK has been in a technical recession, second half of last year, 2 quarters of negative growth, and maybe the economy now is a little bit more resilient short term. And then I think the budget, it's probably well flagged up, and it's probably also the kind of thing where they didn't want to do something unlike the Truss Kwarteng budget in the autumn of 2022 that really shocked the market and shocked the world, I would say. So what's happening, I think, is that UK politics is moving back to the center, right? We've sort of thrown our toys out of the pram here with Brexit and with Truss, and kind of looked over the brink into the edge of a financial collapse, and said, "Oh no, we don't want that." So policy and politics becoming much more center weighted, and if anything, Labour has come in from the kind of radical Corbyn left to the Sir Keir Starmer, kind of Tory Blair, more or less in line with the Conservatives. And I think you see that on the Tories too, right? Stealing some of Labour's clothes, getting rid of the non-dom, various things that really mean that policy is going to be fairly constrained. And if anything, there'll be some continued marginal improvement in the relationship, trading, investment relationship with continental Europe, right? So it probably isn't, it's an important election in some sense, right? Because it probably means the Tories go out into the wilderness for a while and have to reinvent themselves again.
It will be quite a while, but it depends what we see coming through in terms of some of the other minor parties coming through. But the big thing is really in terms of the Bank of England is that sterling has been one of the best performers in the G7.
Right.
So far this year, the Bank of England has been very hesitant in many ways in terms of discussing when they're going to cut rates.
And I think that's going to continue. I think the UK has this, if you look back far enough, has this pretty poor inflation record because it's a relatively small, relatively open economy. Sterling volatility passes through to inflation relatively quickly, certainly compared to the Eurozone or the US, right? The pass-through is much smaller because of much larger, more closed economies overall to trade, compared to the UK. And so, the market is priced for the Bank of England now to move later and maybe less than the others. And I think that makes sense, and that's sterling supportive. It's also part of our weak dollar, general weak dollar, soft dollar, not very weak, soft dollar view. And so, in a way, I suppose a lot of what's going on in sort of big picture, macro, cyclical stuff is kind of back to the future, right? Mm-hmm. We're going back to how things used to be maybe, or not all the way, but in the direction of how things used to be in the 90s and 2000s, not so much the 2010s, right? Where rates were at zero everywhere and where central bank balance sheets were expanding and where it was all about capital gains in asset classes of various kinds. Now it's maybe more about income, dividends and yields on bonds and bond-like stocks. Maybe a little bit less of a kind of long duration in everything, long duration in growth and tech stocks, long duration in bonds, long duration in real estate, right, in everything. Maybe it's a bit more of a mixed and variable market, and so there's more value in portfolio diversification rather than concentration in growth, technology, duration.
It's interesting you mentioned that, because if we go back to what's been happening in the US with the tech stocks, obviously with the AI frenzy, we've seen the Magnificent Seven, 5 of which are actually tech stocks, 2 are in retail. And there's been a lot of concerns about valuations, the breadth of the market, sustainability of this, and what's happening across, not just within the US, but the wider European market as well. We see there are some tech stocks out of Europe, but moving across into pharma, into other sectors, energy, for example. Given what you've just said, what does that actually mean potentially for the continued boom in the equities market?
Okay, look, I think there's a lot going on here. So I would say first on the kind of concentration in the Magnificent Seven and others, I think part of that has been the very low interest rate environment, which has also supported passive and the ETF technology, financial technology, if you like, has enabled that. Mm-hmm. It's likely to continue. Now, the part of the story here that is about interest rates is the part that I'm suggesting may be changing. Another part of the story is this fourth industrial revolution, is this kind of structural change in the technological frontier and in the productivity story. And I think that's going to continue. AI is probably, cutting edge of it. We'll see how much it changes, how quickly. These things usually take a lot of time. But, there's a lot of history suggesting that the market prices these things in, the stock market prices these things in very early, and, tends to go through manic, even bubble phases, right? The dot-com bubble was probably about that. It's come good now. It's come true, right? A lot of those companies are, but 20 years, it's an industrial revolution. Yeah. And that's, 20 years isn't that long for these big structural changes in the economy, which is what an industrial revolution actually is. So I think that part of the story will go on. And I think what makes it maybe less of a bubble now is that most of the all of the Magnificent Seven are serious companies, right? They have a lot of free cash flow. They buy back stock from time to time. They issue debt from time to time. They do, it's not all about the cash burn ratio. And, the more cash you burn, the more likely you are for your stock to go up, as what seemed to be the case during the dot-com bubble, when these companies were still, when the companies in the dot-com bubble were still, kind of a hope and a prayer, right? All I'm suggesting is that the interest rate component of this, in keeping with the discussion we had about the neutral rate, that's going to take some of the froth out of the market as a whole.
So we see the gold market obviously rising in this environment as well. Part of that due to increased geopolitical risks. It's always been a safe haven. Will that continue? Do you foresee that continuing? What other factors, if we are looking at a weakening dollar, obviously that's supportive to gold going forward, and potentially to silver and some of the other commodities. How do you see this moving forward on the commodity side?
Okay, well, so I think first if we start with gold and digital gold, as you say, look, I think several things are going on here. One, the dollar is softening, as you said. Real yields, if the Fed is done and the next move is down, and the same with the ECB and eventually the Bank of England, the global interest rate environment will probably calm down a bit for a while, and real yields probably come down to some extent. That's going to be supportive for long duration, notwithstanding what I said about how it's not all about duration. Still can be supportive for long duration assets, including those that don't have any yield and don't really represent a claim on any kind of cash flow, which is the case with gold, nobody's currency, and also the case with Bitcoin. which I guess is the argument for the digital gold analogy, and I think that makes sense. Now, gold has, as you say, there's the geopolitics, right? A big part of the story here is that central banks are buying. A big part of the story is that India, China, maybe Turkey to some extent, people, individuals, households are buying more gold for consumption, jewelry, maybe for savings, maybe in the case of China because the stock market isn't doing so well, the real estate market isn't doing so well. What it means is that the rest of the world has to adjust to a China which is not going to deliver these massive growth booms that lifted much of emerging markets along in its wake in the past, right? So I think the big picture was that in the era of globalization, China was a source of disinflation in the West and a source of growth support in emerging markets. And maybe to some extent those things are changing. Not very dramatically, as you say, there's deflation, at least disinflation, maybe some risk of deflation. There's still a lot of excess capacity, so it's probably not going to add much inflationary pressure. But as they try to rebalance the economy, make it less dependent on infrastructure investment and real estate investment, it may be less supportive for those countries in emerging markets that were big suppliers in the supply chain for China on that front. Maybe the focus shifts to other things in the supply chain, like the green transition, EVs, the high-tech sector.
Given all of that, and that point, because those are based upon trading relationships, and as you've mentioned earlier, trading relationships are changing, particularly out of the US. We've seen there was no agreement at the recent WTO meeting on a number of issues coming through. So now that we see particularly US companies, some European companies, reshoring, friendshoring, nearshoring, moving out of China as the main source of its supply chain, extending into other regions, other countries. What are the implications on this, given that the political cycle that we are also in? Again, we've mentioned the US election this year, that as we get closer towards the end of that election cycle, we'll be obviously hearing quite a bit more about China from the contenders. And that same thing will probably happen within Europe. We have the European parliamentary elections in May.
Yeah, look, so I think on the political theater that is always the American election, maybe even more so, even more melodramatic than usual, and as you say, to some extent in Europe, I think people around the world, including in China, expect China bashing, right? I think they would be surprised if they were not, to be delivered an enormous amount of China bashing, particularly from one Donald Trump, right? If you think back to the 2016, 2020 elections, China, all this kind of...
Absolutely, but there's the issue of the semiconductor industry, of course, most of it based out of Taiwan. So given that, and that we've seen this huge growth in AI, I mean, what are the implications of that now for China?
Well, look, I think it is a challenge, and it continues to be a source of tension in the bilateral relationship between China and the United States, and in the trading and investment relationship, and it's not going to go away, as you say. I think there are voices on both sides of this divide, trying to say that within the U.S. on both sides of the aisle, trying to say that the more we do this, the more China is going to pursue its own strategy and develop its own semiconductors.
Moving beyond China and the point of emerging markets, but also still within emerging markets is the point of oil. Because oil has remained relatively range-bound over the past several months, despite the events in the Middle East. We've not seen a massive jump up. There was an initial jump up, but it's actually settled back down again. Why do you feel that is the case, and where do you think oil will be going in terms of both the geopolitics and this point of the energy transition? And you've referenced the energy transition several times. We have the Green Deal out of the States. We have one in the EU. But there's also been a lot of pushback to it.
Yes. I would say there's been a backlash, right, against all of this, and the UK has maybe led the way in rolling back some of its commitments, under the Tory government, and it's possible that, if Trump wins, that we get more of that kind of rollback in the US.
Just moving back into that political sphere a little bit, we've danced around a little bit in terms of the US elections. Given that we're going to see highly contested election, what are the implications for the US and the global economy as a result of that, depending upon who gets in office and how close that vote is?
All easy questions, huh?
Yeah, simple ones.
Indeed. Well, look, I think, taking a step back, it's a year of elections. Whatever, half of humanity, I forget the exact numbers, but some, majority, 60% of humanity is voting this year. And there are elections in so many major democracies from, say, the US, the UK, India, Indonesia, Taiwan, as we discussed. And I think I agree with you. The irony is that in this year of all these political turmoil all over the world, almost all of them, it's fairly clear what's going to happen. And as we were talking about in the UK, we're going to have this shift from Tories to Labour, and it's probably not going to change very much. And that's what we're seeing, I think, in most of the world. Like the Taiwan election, I think essentially what we got in Taiwan was divided government, right? We got, the LDP, the Democratic Progressive Party, the DPP, won the presidency but lost its majority in the parliament, in Congress. And so, that I think put China in a position where it didn't have to do very much. And, President William Lai, elect President Lai, has done essentially what the Americans were pressuring him to do, which is to not be very extreme, and anyway he couldn't because he's somewhat constrained. Yeah. And so, the Taiwanese people have basically voted for the status quo, right? Let's, not really change things very much. And I think that's what we're talking about in most of the world. And as you say, the irony is that in the anchor country, in the international financial system, we have all the political risk, all concentrated in a handful of swing states. Absolutely. Probably come down to a handful of voters.
It'll be those what's it, 5 states, basically.
Yeah, absolutely. And as it was the last 2 times, and it seems reasonable to assume that President Trump will lose the popular vote again by some significant margin, but if he wins, it's going to be by a tiny margin, and you know how he is, right? It's going to be a landslide, right? And it's going to be an electoral landslide, and it's going to be the biggest inauguration ever, and I think it's easy to joke about this kind of stuff, and we probably should because it's funny.
What are the repercussions in terms of budget? Because obviously right now we've had the interim budget agreements. We are still not away necessarily from government shutdown. That's still on the cards, which obviously will affect the U.S. credit rating. Yeah. Yes, the dollar will remain, the global currency. I don't think there's any risk of that at the moment. However, and this goes back to the point at the very beginning of our conversation about where that leaves policy.
Well, look. So I think the polarization is there. The whole thing has led to all these kind of difficulties in choosing a speaker, in kicking out the speaker, and then difficulties in choosing the new speaker.
17 times.
17
times together.
And so on and so forth. And so there's a lot of polarization between the left and the right in the U.S. There's a lot of polarization within the Republican Party. And it's interesting, we used to think of the U.S. as a country where the difference between the left and the right was much smaller than it is in the rest of the world.
And now it's swung quite dramatically.
Now it seems to have swung quite dramatically. Yeah. And this budget question, the debt ceiling question, the question of the speaker, I think it's quite interesting because, as you say, in some respects it's swung much wider, a much bigger difference than the rest of the world. But actually, I think it's a difference, sort of on the right-hand side of the distribution of the politics, right? The hard right in the U.S., or let's say the MAGA right, they want a much smaller state, or many of them want a much smaller state. President Trump, it's not so clear, but anyway, we can come back to that if you want. But the big debate in the U.S. is about whether we should have a state that spends about 30% of GDP or something closer to 15% of GDP, right? Whereas here in Europe, we're tinkering around between 50 and 55% of GDP, right? Nobody's really saying, we should really get rid of the state because it gets in the way. What's been happening in this industrial revolution is that the technological advancement has been incubated in the private sector and then moved into the public sector, into the defense realm. Whereas that's even true of AI. Yeah. It's true of drones. Whereas historically,
came from
maybe
the military side, but you had
during the
military-industrial
Cold War,
conversion.
During the Cold War, that was absolutely the case, right? And there may be, maybe it's moving to some extent in that direction because, in as much as we had the Red Scare from the Soviet Union back in the Cold War days, we have this concern about the People's Republic, and that seems to be very state-led, so the state is playing a bigger role. But still, it's much smaller than in Europe, much smaller than in China. Not that the state is necessarily that big in GDP in China, but it's much more present in the economy in many respects. And so what I'm getting at here is that it's not, I don't think, it's not that the mainstream Democrats, I mean, maybe the Warren Sanders wing, the far left of the Democratic Party has a different idea. But I think it's going to be very hard to move even the mainstream Democrats, unless the progressives really get control of it, which doesn't seem likely, to move the needle from 30 to 50% of GDP in the size of the US state. Right? The debate is about, is it 30, is it 25, is it 20, is it 15, right? What is the size of the state? And I think the market has a lot of time for that kind of debate, right? Because that's the only place in the world where you have that debate, other than maybe in my native India where it's really about between 15 and 20, right? So among the big economies, like take even Brazil or South Africa, the state is 30 or 35% of GDP, right? And 40 in the case of Brazil, right? It's a very large share of GDP, even in some emerging market countries. So I think, that is going to, the fact that the US economy is still all about this private sector dynamism, it's still all this, kill what you eat, winner takes all kind of, eat what you kill, winner takes all kind of capitalism, much more so than in Western Europe, or indeed much of Asia. That, I think, is going to keep the US at the forefront of the technological revolution and at the forefront of the market's mind on that kind of question, right? So now, coming back to the political risk, I think the problem here is that, going back to this idea that it's going to be a handful of votes in a handful of states. If Biden wins, Trump may contest that, and we can talk about that, but if Biden wins and remains in power, or the Democratic Party if he's replaced, as you say, they're going to be constrained by that, because they're conventional politicians who feel constrained by the size of the mandate they receive, right, or empowered by it. Whereas President Trump...
They may not also get the House, of course, and they may not get the Senate this time round either.
Absolutely.
So obviously that does leave deadlock.
So whereas if Trump wins, as you say, the coattails are going to matter for the execution of policy, right? But if Trump wins, his reaction to a small margin of victory is the opposite of, in my opinion, is the opposite of a conventional politician. He goes all out because he says to himself, I think what he says is, it's this MAGA thing, this Make America Great Again thing that won me the election, and I barely won. I mean, I think he knows the numbers as much as anybody else, right? He watches TV all day long, right? So he says, what works is to get the vote out. That's the only thing that works for that wing of the party because of the structure of the Electoral College and the structure of the swing state distribution of population and economic structure in the US. So if he's constrained in Congress by the House or the Senate, by the Senate perhaps, as you say, he's going to be more extreme, quite potentially, on policies that the executive branch has final say over. Right?
So a lot more executive orders coming out, essentially.
Executive orders, maybe more aggression on trade. Maybe to some extent Congress has constrained him formally on NATO.
Yeah.
And yet, candidate Trump is already undermining NATO by saying Article 5, I'm going to reinterpret Article 5. And those countries that pay their fair share, maybe they'll get support. But everybody else, Putin can do what he wants, right? It's kind of, these kinds of things are, he's not necessarily going to follow through with all of those kinds of things, but he could say them, and they could have a lot of force if he's the president. They already have force as a candidate, right? So I think with Trump, it's going to be a different kind of world. Now, I think the first Trump administration, he took aim mainly at the rest of the world and only to some extent at American institutions. This time, he's probably going to be aiming at both.
He's been focusing a lot more on these institutions that he already wanted rid of the Environmental Protection Agency. They're, as you said, about the Fed and the question
and
of
after
Fed
all, they
independence.
stole the election from him in 2020. So he's going to feel vindicated and maybe be more aggressive. At least we have to, kind of contend with that risk. And that's, so I agree with you completely, right? We have this spate of elections. Most of them are not that risky. The US election is the most uncertain as to outcome and as to policy impact. And I would suggest, the impact is not going to be in 2024. It's maybe going to start in 2025 when the new president comes in or, re-enters office.
Looking at all of that, and this circles back to the very beginning of US policy, what will be happening in terms of markets moving forward, where do you see the market over the next few months, both in terms of equities still remaining at their highs, yields coming down, depending, and where do we see happening with currencies? You said the dollar softening, but at what stage?
Yeah, so I think we're sort of in the kind of final innings of the dollar strength era. I wouldn't say that we're going to have a very weak dollar, but a softer dollar because the Fed is going to start to ease, and I think that's going to gradually bring down long-term yields and support the equity market. I think it's going to be a little less all about the U.S. as this happens, and a bit more about maybe Europe to some degree, some emerging markets to some degree. Japan, as you said, we'll see about China. I think the foreign investor is on a buyer's strike in China, and the domestic investor is as well. So if there's a place that is primed for an upside surprise, it might be China if they do a little bit more stimulus than expected, and if performance therefore is somewhat stronger than expected. I would say it won't be gangbusters because, stick by what I said earlier, they want to rebalance the economy, make it less dependent on debt, make it more of a kind of a stable growth story rather than this famous
well, it's that increase in
quality of
domestic
growth.
demand and moving out of, in many ways, that middle income trap.
Right. That would be, I think, a big part of the objective, and I think they'll continue to try to move in that direction. So I don't see that there's room for a massive shock because rates are, you can't rule it out, of course, but because rates are going to have to come down. If it does happen that rates come down very sharply, it'll be because something has broken. And in that scenario, given where assets are priced, there's likely to be a big pullback first before there's a recovery trade on the back of a big sharp cut in rates. I think it's more likely that we get is a kind of stabilization story where inflation is coming down, growth is holding up, and growth is kept going because rates come down, because what the Fed does is so-called maintenance cuts, right? They don't want to cut passively if inflation, they don't want to tighten passively by not cutting as inflation comes down, right? So they start to cut, they cut gradually because inflation continues to go down.
It's about
over
the
time.
timing for the Fed because they've gotten it
Second
very
half.
wrong in the past.
Yeah, absolutely.
I mean, quite frankly, getting to this point of a potential just soft landing has been a bit of luck.
Well, I think there's been luck in it. There always is. I think there's been some skill as well. Look, I mean, I think it's fair to say we had a boom. We had a bust in the pandemic. We had a boom on the reopening, supercharged in the case of the U.S. by all these fiscal transfers
yeah.
and the monetization of those fiscal transfers. And yet it doesn't look like we're going to have the bust, right? So maybe we have bust, boom, and normalization instead of boom, bust, and then normalization, right? That's what I'm thinking anyway, which is, I think, a constructive story. It's not outright bullish. It's this kind of bumpy landing idea that we talked about earlier, right? That it's not all no landing. It's not a full-blown soft landing because some stuff is starting to come off the boil and some of it will hit the skids, but not all of it.
Thank you very much, Arnab. That's a wonderful overview of what we can look forward to for the rest of this year and beyond. Thank you very much.
Thank you.
Well, I hope you've enjoyed today's discussion with Arnab Das, Global Macro Strategist at Invesco, and we look forward to lots more conversations in the future in our Horizon Bites series, so stay tuned.